Green across the board, the 10-year yield is hovering around a 3-month high now. Investors looking ahead to this Friday's jobs report and what it might mean for the next Fed meeting. Joining me now to discuss, Richard Fisher. He's the former Dallas Fed president, the Jefferies senior advisor, also a CNBC contributor. Welcome. It's nice to see you.
Thanks, Scott. Thanks for having me. Appreciate it.
What are they going to do in this meeting after the election, you think?
I don't know, to be honest with you. I always think of what I would be arguing if I were sitting still at that table. And as was just pointed out by Tony and others, we have good economic growth at 3% or so, most likely in this quarter. Pretty full employment. Manufacturing continues to suffer, but there still is demand for services. So if I were sitting at the table, Scott, I would probably be almost arguing there's no need to do anything. We don't do it to satisfy the stock market bettors that are depending on every little bitty move. We have to realize that after the last 50 basis point cut, from the 6-month all the way out the yield curve on treasuries, rates are higher. You just pointed out the 10-year. It's also true for the 1-year, for the 2-year, for the 6-month, and the 30-year. So the question is, why is that happening? And as you know, I have my own theories about that, but I'm not sure it makes a difference, frankly, at this point. And I would probably be arguing, let's just settle in here. I'm willing to accept 25 if the rest of the committee wants to do it, but I'm not sure it's necessary at this point.
Well, what do you actually think the chances are of a pause, either at the November meeting or the last one of the year? You're not the only one suggesting at this point that, you know what, maybe they only go one more time this year. Maybe they go next week and then they sit back and they just wait and see what happens.
I would expect another quarter sometime this year. It could be at either meeting. But again, for this meeting, I don't think it's necessary. There's still a lot of data that we want to see. And if you take an extra month or an extra 6 weeks, that's the way the clock works, it gives you more time to examine the data.
Is this also because, you know, I think what's being proven out, obviously, I don't think I'm breaking any new territory with suggesting this, but the neutral rate's obviously higher than where they once thought.
Right.
By virtue of the fact that growth is as strong as it is. So they're not as restrictive as they probably thought they were, which gives them the luxury maybe of just doing that one you suggest and then taking their time to see what happens with the data. How would you assess that?
You know, I would have a button at the table and just play what you just said. Financial conditions are still fairly lenient. Spreads, as you know, are narrow, even though the rates have risen. The credit markets are fairly flush still. We have a lot of private credit out there. And I think still, and look at the stock market, we are accommodative here. So what's the need to push on that string? I'm not sure.